Tony Watson here with Robert Hall & Associates. Today we're going to talk about the differences between true credits and deductions. Remember that credits and deductions are two completely different things. A deduction is an expense that you're trying to take as a write-off against income. A credit actually is something that will reduce liability after your deductions have already been taken into account. I'll give you an example. In 2015 and 2016 we have something called the electric plug-in vehicle credit. Now this credit is not a true credit, but it is a credit that offsets liability, meaning that after my deductions and everything else are taken into account, let's say that my tax is about $8,000. The plug-in vehicle credit of $7,500 will actually reduce my $8,000 tax liability by $7,500, dollar for dollar. Well, let's say that even though my tax was $8,000, let's say I had $10,000 withheld. And so therefore, if my $10,000 in withholding covers my $8,000 liability, I'm looking at about a $2,000 refund. Well, even if I'm looking at a $2,000 refund, but my tax overall was $8,000, my $7,500 plug-in vehicle credit will add $7,500 on top of my $2,000 federal refund. So even though it's not a true credit, it still is meant to offset any tax liability that an individual taxpayer shows on their individual tax return. Now, once again, that's not a true tax credit. But does everybody remember the first-time homebuyer credit of $8,000 that I believe expired in 2013? That $8,000 first-time homebuyer credit was a true credit, meaning that you could show negative income on your tax return and still receive an $8,000 tax refund if you bought a home as a first-time homebuyer. That is what's called a true credit. A deduction is mortgage interest, or property taxes, or cell phone expenses, or charitable donations. These are deductions that help reduce your taxable income. Okay, so there are significant differences between credits and deductions. Other credits, such as the American Opportunity Credit for the education expense, the Earned Income Tax Credit if you're a single parent and you have dependents and your income is below a certain threshold, the federal government will actually give you money for being a single parent. That's called the EIC credit, the Earned Income Tax Credit. And so make sure that you're sitting down with your tax preparer and exercising every right that you have on your individual tax return to max out these credits. But more importantly, make sure that you know about the credits before you file your tax return. And the only way that you're going to know about these credits is either by educating yourself or picking up the phone and calling your tax advisor. So pick up the phone and call Robert Hall & Associates, and we'd be more than happy to walk you through any of the credits that you may qualify for in the upcoming years. Thanks for stopping by.